Let's bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. Let's focus on beginners today. Now, given where the market is right now and given what we've seen happen over the last 6 months, is it a good time for anyone who wants to get started to begin an investment portfolio in equity?
I would say that the primary driver for an investor to think of equity should be not based on the state of the market, but your own time frame. If you are investing for 10 years, 15 years, then by all means it's always a good time. Even if it was 2008 beginning or if it was 2007, it still makes sense. Because when you are investing for 10-15 years and investing regularly, all the market risk you will be able to navigate. Your time frame is more crucial than the state of the market. So yes, get started. If you have never invested before, then I would suggest that start on a slightly conservative note. Start with something which is relatively more stable than an all equity investment. I would say consider a balanced fund from our stable growth portfolio, and that is something which should give you a decent experience. Important thing is that staying the course, keep investing even through the lean times. It will be very difficult sometimes when you see that your investment is not performing because of the market in 6 months time frame, 8 months time frame. But ignore the noise. Have this faith, and these kind of time frame over 10 years, one is unlikely to be disappointed, more so if one is investing through all the difficult times in the market.
Well, Dhirendra, you did say that someone who's starting off should use a balanced fund. I'm going to ask you to be a little more specific and name a couple of balanced funds that beginners can use at this point.
I would say consider balanced fund, and balanced fund from our stable growth portfolio. If I have to list some, I would say ICICI Prudential Balanced Fund or Franklin Balanced or Reliance Balanced.
All right, we have a question, in fact, this afternoon that's coming from one of our viewers. Now, he's a beginner. He tells us he received about 1.2 lakh rupees as a performance bonus, and we're quite happy for him. Apart from this, he manages to save about 10,000 rupees every month. He wants to know whether he should invest that money as a lump sum and also what he should be doing with that monthly saving. Dhirendra.
I would say that you should be guided by when you are likely to need the money. If you are unlikely to need this money for many years, I would say don't invest it in a lump sum. Put your money into a liquid fund or a ultra short-term bond fund of the equity of the same fund house in which you want to invest. So thinking of a couple of years, if you decide to invest in a Franklin's fund or a ICICI Prudential fund, then invest in the liquid fund and move your money 10,000 rupees a month or 8,000 rupees a month over the next 12, 14 months, so that you are eliminating the possibility of you are averaging your investment and eliminating the possibility of making your lump sum investment, and just in case the market goes down, you'll be too anxious. So managing your own anxiety, eliminating the possibility of catching a market peak, move your money gradually.
All right, Dhirendra, thank you for that answer. So that's very useful actually at this point as we near into the festive season. What to do with your performance bonus for the year. Dhirendra, they're giving us a plan. Use a systematic transfer plan and invest that money into equity with it.